What kind of loans are being doled out, and what's the risk factor here?
Well, the concern is there's something called a subprime auto loan, which is a loan that is extended to people with FICO scores or credit scores below a certain amount. And so these are less credit-worthy investors or borrowers, not investors, borrowers, and they are getting loans to buy cars, and these loans are being made for longer and longer periods of time. Now, you know, the average time, the 74% of loans made this year of subprime loans have maturities that extend out beyond 5 years that have been bundled into these.
And why is that significant when we are seeing the average life of a car extended to, say, 11 years, 5 years, and it doesn't look so bad?
Well, first of all, if you're a borrower, you're paying a lot more. Number one, you've got, you know, with 27, 28% possibly interest payment that you have to make on this loan, and you're paying it out over 5, 6, 7 years, which means that you're paying a lot more money. But number two, the value of a car depreciates dramatically after a certain point. So you could have a situation where a lot of these borrowers are underwater, where essentially their vehicles are worth less than what they're required to pay back. You don't want that. That is a bad situation.
Subprime crisis indicator.
Exactly.
And then to that point, I want to take a close look at a debt offering by American Credit Acceptance. About 1/3 of the loans in the deal are actually tied to borrowers with credit ratings under 500, like you mentioned, huge interest rates. Those loans exceed 5 years. Are people buying?
Well, clearly, I mean, they're selling. I think that some people are not buying, and they're saying, look, we just don't trust this cycle. Yes, typically the line is that people will pay back their auto loan before they pay back their mortgage because they need to get to work on time. But will they keep paying back that auto loan, as one person noted in this story written by my colleague Matt Scully? Are they really going to pay that back if their car is not worth anything and if their car doesn't work?
Right, which is a good point. And obviously the big sort of elephant in the room here is the search for yield among bond investors. When you have low Treasury yields, does this change as the Fed raises rates?
Well, this is actually typically, auto loans are typically floating rate debt, so it could actually be okay and somewhat insulated. The problem is people will be less inclined to go into riskier securities. A lot of people who invest in securitizations, which is this kind of debt that auto loans are often packaged into, they want to buy AAA rated paper that's backed by these subprime auto loans. There just are so many loans backing the little amount that you get that there's so much excess payments that you get your money back and then some. The point
the bad stuff is mixed so with so much of the good stuff that it offsets.
Well, the way that securitizations are arranged is you've got a pool of these auto loans, and then people buy bonds backed by that pool, and the top rated bonds are basically, there would have to be so many losses before the top-rated bonds get any losses. We saw this with mortgage securitizations, though, and there were so many losses because a lot of these loans were underwritten in a way that was not to the strength that some would be interested in. And the SEC, frankly, has looked into subprime auto loans, particularly last year. They did investigate some underwriters of these to basically say, we want to know what's going on. We're concerned about how much the underwriting standards are deteriorating.
Good stuff. Do you own a car?
No.
Me neither. All right, not the target audience. All right, thanks so much, Lisa, for breaking down the subprime auto loans.